When selling a business, there's typically 3 different types of buyers. These buyers have different levels of sophistication, access to capital, needs, and will likely all evaluate your business using differing methodologies. It's important to understand who these types of buyers are and the most logical to acquire you, so the right levers can be pulled when preparing for a sale. First type of buyer we're going to talk about is the owner-operator. This is the corporate refugee who no longer wants to work for a big company and would prefer to own their own business and control their own destiny. In many instances, this type of buyer is putting a down payment on the business from their personal balance sheet and obtaining a loan from a bank using the SBA loan program. SBA loans for business acquisitions can go as high as $5 million, so the owner-operator is not restricted to small mom-and-pop businesses. The second type of buyer is a strategic buyer. A strategic acquirer is typically acquiring a company in the same industry or on the periphery of the business being sold. They could be looking to expand to a new geography. Perhaps they want to vertically integrate by bringing a process in-house that has been previously outsourced. Or they could be getting into a new product or service line that can be easily cross-sold to the existing client base. The strategic acquirer is often looking for revenue or cost synergies with their business. They'll often have a stronger balance sheet than the individual owner-operator, as well as have existing lines of credit and banking relationships. The third type of buyer we'll talk about is a financial buyer. This buyer is looking for an investment opportunity. It's quite often a private equity group looking to deploy capital raised from its limited partnership investors. But this type of buyer also contains the family office and high net worth individual. The commonality of the financial buyer is that they're not looking to run the day-to-day operations of the business. They're typically looking for management to stay on in their existing role, while the financial buyer sits on the board of directors and offers strategic direction to the company. In most instances, the financial buyer has a holding period of 6 to 10 years. So the goal is either to grow the business or cut costs in order to be able to exit at a higher valuation. There's no hard and fast rules about who's going to pay the most for the business. It's very much dependent on the size of the company, ability for the business to scale, industry, and needs of the buyer. Additionally, each type of buyer will have restrictions on how much they can pay or how they structure deals that are caused by their banks, their investment policy, and their culture. Each business owner needs to evaluate a variety of factors to determine where they might hit different restrictions for businesses, types of buyers, and who can create the most value for the seller. Once it's determined, the business can make strategic operating decisions that optimize the company for a sale. We'll talk a bit more about the opportunities and restrictions for each types of these buyers over the next couple of episodes, so we'll see you soon.